Hey everyone, let's just jump right in. Today we're diving into a really fascinating explainer on Intuit's Q3 fiscal 2026 financial results. We're looking at a quarter that threw some serious curveballs at the market, mixing record-breaking financial momentum with some aggressive and honestly surprising internal shifts. If you want to understand what's really happening under the hood of this massive fintech giant, you are in the perfect place. So here's the ultimate Wall Street riddle for you. How exactly does a company completely crush its earnings estimates, confidently raise guidance for the rest of the year, and still watch its stock price tank in after-hours trading? Well, that's exactly what happened to Intuit this quarter. We're going to break down the data to understand the logic behind the market's reaction, separating the headline noise from the real, fundamental business reality. Here's our roadmap for this explainer. We'll hit the Q3 paradox, revenue and profit wins, the growth engines, strategic costs, the financial fortress, and finally, vision and future. Let's get to it. Part 1. The Q3 paradox, record highs versus workforce shock. Okay, so this quarter is defined by this massive, almost jarring contrast. On one hand, Intuit hit incredible top-line growth and even raised their full-year guidance. Huge win, right? But on the exact same day, they announced a massive 17% cut to their full-time workforce. Now, management said this was a strict move to simplify the organizational structure, to make the company faster and leaner. It wasn't pitched as some desperate cost-cutting move to save a sinking ship, but rather a really deliberate reallocation of resources to scale up their AI projects. But this dual narrative, booming revenues right alongside massive layoffs, that is exactly what injected so much uncertainty into the market. All right, Section 2, Revenue and Profit Wins, breaking down the Q3 beat. Let's strip away all the market feelings for a second and just look at the raw math from their 10Q filing. Total net revenue jumped to $8.56 billion. That is a rock-solid 10% increase year over year, compared to the $7.75 billion they brought in during Q3 of last year. This isn't just a tiny beat. It's a massive expansion of their core business right in the middle of a highly competitive tax season. When you think about the sheer scale of Intuit, adding over $800 million in new quarterly revenue, that is a massive achievement. And you know what's great? That top-line growth translated beautifully right down to the bottom line. Non-GAAP diluted earnings per share hit $12.80. That's up from $11.65 a year ago, which is nearly a 10% jump year over year. This tells us Intuit isn't just buying revenue with sloppy spending. They're actually turning that sales growth straight into real earnings power for their shareholders. Looking at absolute profit, GAAP net income hit a staggering $3.06 billion, a 9% increase. So what's driving this? Well, mostly it's fueled by higher operating income across their main segments, which we'll unpack in a second. But it's also worth pointing out they got a nice little boost from $46 million in net gains on their long-term investments. This combination of solid operational execution and smart treasury management, that is exactly what you want to see. Moving on to Section 3, the growth engines. Global business solutions versus consumer. So we know the company grew, but where did that money actually come from? It's really a tale of two segments here. Global Business Solutions, which serves small and mid-market businesses, was the absolute star, growing at 15%. On the flip side, the consumer segment, which relies heavily on TurboTax, grew at a more modest 8%. Now, 8% isn't terrible, but management openly admitted they faced some headwinds with their most price-sensitive do-it-yourself tax filers. But, as we'll see, a specific premium offering completely saved the consumer segment's quarter. Now, what's really interesting about this slide is how effectively Intuit is transforming into what they call the control tower for businesses. Check out these metrics. Their B2B online ecosystem revenue grew 19%. Even more impressive, their mid-market offerings, stuff like QuickBooks Online Advanced and the new Intuit Enterprise Suite, those skyrocketed by 38%. And because they're baking financial services right into the software, total online payment volume jumped 30%. They are successfully reeling in larger, more complex businesses and literally monetizing the flow of money. Switching gears to the consumer side, remember that weakness in the DIY segment I just mentioned? Well, it was completely offset by explosive demand for done-for-you services. Users of TurboTax Live, where you actually get help from an expert, grew by a crazy 38%. Honestly, TurboTax Live now makes up 53% of all TurboTax revenue. Since it's a premium service, average revenue per user shot up by 11%. So sure, fewer people might be doing their own simple taxes, but the ones who are paying into it are paying them significantly more for that expert AI-assisted help.
All right, Section 4, Strategic Costs, Fueling the AI Engine. So the crucial point is, to understand why a company pulling in billions would just chop 17% of its workforce, you have to look under the hood at their operating expenses. Look at research and development. It jumped from $707 million to $840 million. Selling and marketing also took a massive leap, hitting $1.79 billion. While general and administrative costs stayed pretty flat, the cash they're pouring into creating and selling new tech is accelerating really fast. This tells us they are in a massive investment phase. And the sources make it crystal clear. These rising costs are 100% intentional. They're deliberately funding huge increases in outside hosting services, specialized staffing, and SaaS subscriptions. Why? To build out a massive proprietary AI infrastructure. They are basically betting the whole farm on becoming an AI-driven expert platform. And doing that means shifting capital away from legacy operational roles and pouring it straight into cloud computing and AI development. Next up, Section 5, the Financial Fortress. A look for investors. So how does all this synthesize for an external investor looking at the stock right now? This is where the market's reaction gets a bit wild. Based on independent discount and cash flow models using these Q3 earnings, Intuit's intrinsic value sits somewhere between $496 and $527 a share. With the stock trading around $384 to $399 post-earnings, these models scream that the stock is actually undervalued, presenting a potential upside of 24% to 34%. It really looks like the market is heavily discounting the stock because of restructuring jitters, while totally ignoring the incredibly strong fundamental cash flows the business is generating. And those cash flows are backed up by an absolute fortress of a balance sheet. Intuit is sitting on $6.8 billion in cash and investments. Yes, they have $6.2 billion in long-term debt, but that's highly manageable given the revenue scale. More importantly, their equity capital management is super shareholder-friendly. They're actively using their cash reserves to fund share repurchase programs, which decreases the total number of shares and boosts EPS. And they're keeping up those steady dividend payouts. They're seriously committed to returning value to shareholders. Finally, Section 6, Vision and Future. The AI-driven expert platform. Let's move to the future and see how this all builds together. Intuit isn't just trying to survive the quarter. They want to redefine their entire industry over the next decade. Management laid out their strategic priorities to capture a total addressable market they estimate at $300 billion. They're making 3 big bets. 1, aggressively scale those highly profitable done-for-you experiences with TurboTax Live. 2, dominate the mid-market by migrating complex businesses onto the Intuit Enterprise Suite. And 3, accelerate money benefits, meaning they want to be the ultimate all-in-one AI platform managing payables, receivables, and capital, going way beyond just basic tax compliance. And this brilliantly illustrates exactly why they're so confident in that mid-market bet. The data from their 10Q filing shows this incredibly reliable, sustained momentum in their global business solution segment over the last year. It's just a beautiful stairstep of consistent, high-margin revenue growth. This isn't some pie-in-the-sky future product. This ecosystem is throwing off billions in operating income right now, proving their platform consolidation strategy is absolutely working. Which brings us right back to the elephant in the room, the restructuring. To achieve this AI-driven future, management expects to take a $300 million restructuring charge in Q4 to facilitate that 17% workforce reduction. It is a painful, massive operational shift. But looking at the sources objectively, this is a highly calculated pivot. They are cutting away legacy structures specifically to free up the hundreds of millions in capital they need for that AI engineering and cloud infrastructure we talked about earlier. As CEO Sausan Goodarzi put it on the earnings call, their ultimate goal is redefining the future of trusted financial intelligence. They clearly believe that making these tough structural changes right now is the absolutely necessary step to operate with the velocity needed to win the AI era and to deliver that long-term value for both their customers and their shareholders. So what does this all mean? We'll leave you with this to ponder. The market definitely punished the stock over the restructuring surprise, but the fundamental revenue and net profit engines are firing on all cylinders. Will the short-term shock of this massive workforce reduction actually be the exact catalyst Intuit needs for long-term dominance in the financial AI era? Definitely keep an eye on those Q4 margins. That's going to give us the ultimate answer. Thanks so much for joining us for this explainer, and we will catch you next time.